Good morning, Curtis Chandler here, President of PFL, bringing you last week's North American rail, energy, and macro update. Let's break down what is driving the conversation out there. Across the board, momentum slowed. Major U.S. equity indices all closed lower, led by NASDAQ, which dropped 2%. Even with oil sliding on Friday, crude held weekly gains as product inventories remained uncomfortably tight, especially for gasoline and distillates. Refinery runs are steady but can't fully offset these supply constraints. Labor market indicators are cooling. Jobless claims inch up. Unemployment rose to 4.2%, and job growth for July underwhelmed at just 73,000, a notable slowdown. Saving rates and low wage growth is softening. Consumer spending after inflation barely nudged ahead of last month. On the rails, overall North American rail volumes continue to decelerate. Total carloads and intermodal each slipped year over year, with the fastest decline in forest products. Not all news was negative. Autos and parts gained as manufacturers tried to get ahead of tariff realities. Rig activity continues to drift down, with a net loss of 7 rigs week over week and 88 rigs year over year in North America, reinforcing a pattern of investor caution in the energy sector. Here's what we are keeping a close eye on for you last week. Petroleum carloads. The rolling average, 4-week rolling average for petroleum rail cars dropped to 72 cars. Canada Class 1s both declined. UP was the sole gainer, and which was up 6% week over week. We are watching pipelines and policy. Enbridge continues to push for new export options, but heavy government barriers and emission caps are holding up West Coast projects. Mainline expansion south remains the main focus, bringing Canadian barrels to premium U.S. markets. We are watching tariffs. New tariffs over 65 countries will come into effect soon. Canada hit the hardest at 35% on non-USMCA goods, are shaking the cross-border supply chain. Steel, fertilizer, and plastics are moving slower, and rail stocks marked down on trade exposure. We are watching Canadian Class 1 earnings. CN is taking a hit, earnings per share guidance downgraded, and their multi-year outlook withdrawn entirely. CPKC, meanwhile, saw strength in intermodal offsetting the impact of other lines. We are watching merger buzz. UP, 85 billion move on NS is getting major regulatory and consumer pushback, with consensus centered on lost shipper flexibility and fewer routing options. We are watching short lines. Efficiency moves by big rails are creating both new service opportunities for smaller operators, but also higher risk if their mainline partners change their priorities. We are watching interest rates in the macro backdrop. The Fed and the Bank of Canada left rates untouched, aiming for stability while uncertainty reigns. The interest rate environment continues to favor leasing over equipment buying in railroad. We are watching U.S. and labor and consumer pulse. Unemployment is up, savings remain thinned out, and real spending growth is minimal. GDP was 3% in Q2, which was a primary result of higher imports. We are watching inflation. Producer and consumer prices show only minor monthly increases. Annual inflation sits near 2.4%. Slower wage growth and shrinking savings suggest consumers are keeping a tighter grip on their wallets. For the latest updates on equipment for sale or lease, customized rail solutions, contact PFL. Remember, we clean cars, flare cars, store cars of all types across North America. I'm Curtis Chandler. Thanks for listening. Stay prepared, stay positive, and take what comes one day at a time, and call PFL if you need some help. Please read today's report. We do it all for you, and we hope you have a great, safe week out there.